Most people believe they need a higher salary to become wealthy. Warren Buffett has spent decades proving the opposite. He has watched people with six-figure incomes stay broke, while ordinary earners quietly built fortunes that lasted generations. The difference wasn't intelligence. It wasn't luck. It wasn't timing. It was behavior. In this documentary, we're going to uncover the 7 everyday habits that silently keep people poor, the same behaviors Warren Buffett has avoided throughout his entire investing career. These aren't obvious financial mistakes like buying expensive cars or skipping a budget. They're deeper psychological patterns that slowly destroy wealth before it has a chance to grow. By the end of this video, you'll understand why so many hardworking people never become financially free, how Buffett thinks differently about money, and what practical changes you can make today to start building lasting wealth instead of constantly chasing it. Because sometimes becoming rich isn't about doing more. It's about finally stopping the things that have been keeping you poor all along. Imagine walking into a room where everyone is shouting about the next big investment. One person is promising a stock that will double in a month. Another claims cryptocurrency is about to make ordinary people millionaires overnight. Someone else insists that artificial intelligence, options trading, or the newest startup is the only opportunity that matters. The excitement is contagious. The fear of missing out becomes almost impossible to ignore. It feels as if wealth belongs to whoever moves the fastest. But Warren Buffett has spent more than 7 decades proving that this way of thinking is one of the most expensive financial mistakes a person can make. While millions of investors rush from one opportunity to another, Buffett quietly sits in his office reading annual reports, studying businesses, and waiting. That doesn't sound exciting. It doesn't create flashy headlines. It certainly doesn't go viral on social media. Yet this simple habit has created one of the greatest fortunes in modern history. Why? Because Buffett understands something that most people never truly learn. The stock market is full of people trying to get rich quickly, but wealth rarely rewards impatience. It rewards ownership. Think about how most people approach money. They aren't asking, what business would I be proud to own for the next 20 years? Instead, they're asking, what can make me money by next Friday? That tiny difference in thinking changes everything. When your goal is quick money, every investment becomes temporary. You're constantly checking prices, reacting to headlines, refreshing your portfolio, and wondering if you should buy or sell. Your emotions become tied to numbers that change every minute. Fear tells you to sell when prices fall. Greed tells you to buy when everyone else is celebrating. Before long, you're no longer investing. You're simply chasing movement. Buffett has often compared investing to owning a farm or an apartment building. If you bought a successful farm that produced healthy crops every year, would you panic because someone offered you a lower price tomorrow morning? Of course not. You would focus on the farm's ability to produce value over time. The daily opinions of strangers wouldn't change the quality of the land. Yet the moment people buy stocks, many forget this simple principle. They stop thinking like owners and start thinking like gamblers. That's where the real damage begins. The financial world constantly encourages speed. Every day there's another, once-in-a-lifetime opportunity. Another prediction. Another expert claiming they've discovered the next company that will change everything. But Buffett has survived countless market booms and crashes because he refuses to play that game. Instead of asking, how much can I make? He asks, what exactly do I own? That question forces patience. It forces understanding. It forces discipline. And those 3 qualities are becoming increasingly rare. One of Buffett's most famous investments illustrates this perfectly. When he invested in companies like Coca-Cola, he wasn't trying to profit from next month's stock movement. He was buying a business he believed people would continue buying from for decades. He understood the product. He trusted the brand. He believed in its long-term economics. Time wasn't his enemy. Time became his greatest partner. Now compare that mindset with someone constantly jumping between trending investments. Every week brings a new opportunity. Every month brings a different strategy. Instead of allowing one great investment to grow through years of compounding, they repeatedly interrupt the process, paying taxes, fees, and emotional costs that slowly erode their wealth. This is where psychology quietly defeats intelligence. You don't need a low IQ to lose money. You simply need the inability to wait. Human beings are naturally drawn toward immediate rewards. We want visible progress. We want proof that we're winning. That's why quick money opportunities feel so attractive. They promise certainty in an uncertain world. They offer excitement instead of patience. They appeal to emotion instead of judgment. Buffett understands that investing is not a test of excitement. It's a test of temperament. He once observed that the stock market transfers money from the impatient to the patient. That statement sounds simple until you realize how difficult patience becomes when everyone around you appears to be getting rich faster than you are. Imagine planting an oak tree. For years, it barely seems to change. Then gradually its roots spread deeper, its trunk grows stronger, and eventually it becomes something that can outlive generations. Compounding works exactly the same way. The early years often feel slow enough to make people quit. They become frustrated because wealth doesn't arrive on their schedule. So they abandon the tree and start planting seeds somewhere else. Again and again, never allowing enough time for anything extraordinary to happen. The greatest investors understand that the hardest part of building wealth isn't finding opportunities. It's resisting the temptation to abandon them before time has done its work. And that raises an even bigger question. If chasing quick money quietly destroys wealth, what invisible force causes intelligent people to ignore logic completely the moment fear and greed take control of their decisions? Imagine waking up one morning and seeing every financial headline screaming the same message. Markets are crashing. Billions wiped out overnight. Investors panic as stocks continue to fall. Your phone is filled with notifications. Television experts look worried. Social media is flooded with predictions that this time is different. Even your friends begin asking whether they should sell everything before it's too late. In moments like these, most people believe they're making rational financial decisions. But Warren Buffett would argue they're doing the exact opposite. One of Buffett's greatest advantages has never been secret information or extraordinary intelligence. It has been his ability to remain emotionally stable while everyone else is losing control. Throughout history, markets have experienced crashes, recessions, bubbles, and periods of incredible uncertainty. Yet Buffett has repeatedly demonstrated that emotional discipline often matters far more than financial knowledge. Because the biggest enemy of an investor isn't the market. It's the person staring back from the mirror. Think about how emotions quietly influence everyday financial decisions. When prices are rising, confidence begins to grow. People convince themselves that markets will continue climbing forever. They stop asking whether a business is actually worth buying. Instead, they buy simply because everyone else seems to be making money. Greed disguises itself as confidence. Then something changes. Prices begin falling. News becomes negative. Suddenly those same investors who couldn't wait to buy yesterday become desperate to sell today. Nothing about the business may have changed. Its products are still selling. Its employees are still working. Its customers are still buying. Only one thing has changed. People's emotions. Buffett has often reminded investors to be fearful when others are greedy and greedy when others are fearful. At first glance, that sounds simple. But living by those words requires extraordinary emotional control. Imagine walking into a store where every product is suddenly discounted by 50%. Most people would become excited. They would see an opportunity to buy something valuable for less money. Yet when the stock market offers that exact same discount, many investors panic instead. Why? Because our brains react differently when money is involved. Behavioral psychologists have studied this for decades. Human beings naturally experience the pain of losing money much more intensely than the pleasure of gaining it. This emotional imbalance causes intelligent people to make irrational decisions. They sell quality investments because fear becomes louder than logic. They chase overpriced assets because excitement becomes stronger than patience. Buffett recognized this human weakness early in his career. Instead of trying to eliminate emotions completely, he built systems that prevented emotions from making important decisions. Before investing, he studies businesses until he understands exactly why he owns them. That preparation gives him confidence when markets become chaotic. While others react to headlines, Buffett returns to the original question. Has the business fundamentally changed? If the answer is no, then temporary price movements become little more than background noise. This way of thinking separates investing from speculation. Speculators watch prices. Owners watch businesses. That distinction may sound small, but it completely transforms how uncertainty feels. Consider one of the most difficult moments any investor can experience. You purchase shares in a company after careful research. A few months later, the stock falls by 30%. Instantly, doubt begins creeping into your mind. Did you make a mistake? Should you sell before the losses become even larger? Every negative article suddenly feels convincing. Every optimistic opinion disappears from your memory. This isn't because your intelligence has changed. It's because fear has quietly taken control of your judgment. Buffett understands that markets often behave like emotional crowds. Crowds become euphoric together. Crowds become terrified together. But crowds rarely create extraordinary wealth. History repeatedly shows that fortunes are often built by those willing to remain calm while everyone else reacts emotionally. That doesn't mean ignoring risk. It means separating real risk from emotional discomfort. Real risk comes from buying businesses you don't understand, paying unreasonable prices, or ignoring poor fundamentals. Emotional discomfort comes from temporary uncertainty. Most people confuse the two. And that confusion becomes incredibly expensive over time. Charlie Munger once explained that investing isn't supposed to be easy. If someone cannot handle seeing investments fluctuate without panicking, they may struggle to capture the long-term rewards that markets have historically offered. Buffett shares this mindset because he knows volatility is normal. Emotional reactions are optional. Perhaps that's why he spends so little time predicting what markets will do next. Predictions create anxiety because they focus attention on things no one can control. Buffett focuses instead on businesses, management quality, competitive advantages, and long-term earning power. Those are variables that can actually be studied with patience and reason. This approach removes much of the emotional chaos surrounding investing. Instead of asking, "What will happen tomorrow?" he asks, "Will this business likely become stronger over the next 10 or 20 years?" That single question changes the entire conversation. Because once emotions stop controlling your decisions, another hidden obstacle begins to reveal itself, one that quietly drains wealth every single day, not through market crashes or bad investments, but through the small spending choices that most people never question until decades have already passed. Picture two people who earn exactly the same salary. They graduate around the same time, begin their careers with similar opportunities, and receive similar raises over the years. 25 years later, one of them has built a substantial investment portfolio, owns productive assets, and has the freedom to choose how they spend their time. The other is still living paycheck to paycheck, carrying debt, constantly worried about bills, and wondering why financial freedom always seems just out of reach. The difference wasn't their income. It was their decisions. Warren Buffett has often demonstrated that building wealth is not simply about how much money comes into your life. It's about where that money goes after it arrives. Every dollar you earn faces a choice. It can become a temporary pleasure that disappears in days, or it can become an asset that continues working for you long after you've earned it. Most people never think about money this way. Instead, they unknowingly spend tomorrow's wealth to satisfy today's desires. Modern society encourages this mindset every single day. New cars, luxury vacations, designer clothes, bigger houses, the latest technology, every advertisement carries the same message. You deserve it now. Why wait? Success should look expensive. Over time, people begin measuring financial progress by appearance instead of ownership. A larger paycheck often leads to a larger lifestyle rather than a larger investment portfolio. This is what economists call lifestyle inflation, and Buffett has quietly avoided it throughout his entire life. Despite becoming one of the richest individuals in history, Buffett has remained remarkably consistent in how he lives. He still values simplicity over unnecessary luxury, not because he cannot afford more, but because he understands a principle that many people overlook. Every unnecessary expense carries an invisible cost. Most people see only the price tag. Buffett sees what that money could have become. Imagine spending $1,000 on something you don't truly need. At first, it feels like a simple purchase. The money is gone, and life moves on. But Buffett would likely ask a different question. What if that $1,000 had been invested instead? What could it have grown into over 20 or 30 years? This is where compounding begins to change the conversation. Money invested wisely doesn't remain the same size. It grows. Then the growth begins producing growth of its own. Over decades, relatively small decisions begin. creating astonishing differences in financial outcomes. That's why Buffett doesn't merely think about spending. He thinks about opportunity cost. Opportunity cost is the silent price of every financial decision. When you choose one option, you automatically give up another. Buying an expensive luxury item isn't just about what you paid today. It's also about the investment you never allowed to exist. Most people never see this invisible transaction. They celebrate the purchase. They never calculate the future they quietly traded away. Consider how many people receive a promotion at work. Instead of directing the additional income toward investments, they immediately upgrade their lifestyle. A larger apartment, a newer vehicle, higher monthly payments, more subscriptions, more financial obligations. The raise disappears almost as quickly as it arrived. The income increased, but wealth didn't. Buffett understands that true wealth isn't measured by how much you spend. It's measured by how many productive assets continue generating value even while you're asleep. That's an entirely different way of thinking. Instead of asking, "Can I afford this?" he might ask, "Is this purchase helping build the future I actually want?" Those questions often lead to very different answers. This doesn't mean Buffett believes people should never enjoy life or never spend money. His philosophy has never been about extreme sacrifice. It's about intentional allocation. Spend on things that genuinely improve your life, but never confuse consumption with wealth creation. The challenge is that modern culture constantly blurs the distinction. Social media amplifies it even further. People showcase expensive vacations, luxury watches, high-end cars, and extravagant lifestyles. Rarely did they post about the disciplined investing, delayed gratification, or years of consistent saving that create lasting financial security. As a result, many people begin chasing an image instead of building a foundation. They compare their everyday lives to someone else's highlight reel. And comparison quietly becomes one of the most expensive financial habits imaginable. Buffett has never seemed interested in impressing strangers. His confidence comes from understanding value, not displaying status. He knows that appearances can often be financed with debt, while genuine wealth is usually much quieter. In fact, many truly wealthy individuals don't look wealthy at all. They prioritize ownership over image. They allow their investments to grow instead of constantly interrupting the process with unnecessary spending. That requires patience. It also requires resisting one of the strongest psychological forces in human nature, the desire for immediate gratification. Every purchase asks a simple question. Do you want satisfaction today? Or freedom tomorrow? The remarkable thing is that these small choices rarely feel important in the moment. A dinner here, an impulse purchase there, a monthly payment that seems manageable. Individually, they appear harmless. Collectively, they shape an entire financial future. Buffett understands that fortunes are rarely built through dramatic decisions. They're built through thousands of ordinary choices repeated consistently over decades. And once you begin protecting tomorrow's wealth instead of consuming it today, another powerful realization begins to emerge. Because even with discipline, savings, and patience, one investment has the potential to produce returns greater than any stock Buffett has ever purchased, yet most people continue to overlook it year after year. Imagine being given two investment opportunities. The first promises a return that could disappear during the next market crash. The second has the potential to increase your income, improve your judgment, sharpen your decision-making, and continue paying dividends for the rest of your life. Most people would assume the second opportunity must be incredibly expensive. According to Warren Buffett, it isn't. In fact, it's available every single day. And yet, most people choose to ignore it. Buffett has often said that the best investment you can make is an investment in yourself. At first, that sounds like a motivational quote. But if you study his life closely, you realize it isn't motivation at all. It's a financial strategy. Long before Warren Buffett became one of the wealthiest investors in history, he became one of the most dedicated learners in business. While others searched for shortcuts, Buffett searched for knowledge. While competitors rushed to make decisions, he spent hours reading annual reports, newspapers, company filings, biographies, and books on economics, psychology, and business. People often ask what secret gave Buffett such an extraordinary advantage. Many expect a complex formula. Instead, they find something surprisingly ordinary. He reads. Not for entertainment, not to appear intelligent, but because every page improves his ability to make better decisions. Most people underestimate how valuable good judgment really is. They believe success comes from working harder, earning more, or finding better opportunities. Buffett understands that opportunities mean very little if your decisions are consistently poor. Knowledge changes decisions. Better decisions change outcomes, and repeated outcomes create wealth. Think about it this way. Every major financial choice you make is based on what you know at that moment. Choosing investments, negotiating salaries, starting businesses, managing debt, buying homes, building relationships. None of these decisions happen in isolation. They're shaped by your understanding of the world. If your understanding improves every year, your decisions improve as well. That's why Buffett treats learning as an asset rather than an activity. Unlike money, knowledge cannot be taken away during a recession. Unlike stocks, it doesn't lose value because of market volatility. Unlike material possessions, it continues appreciating the more consistently you invest in it. Charlie Munger once described this philosophy by saying that each day you should try to become a little wiser than you were when you woke up. Buffett embraced that mindset throughout his entire career. He never assumed he knew enough. Even after decades of investing experience, he continued studying industries, reading financial statements, and learning from both his own mistakes and the mistakes of others. That humility became one of his greatest competitive advantages. Ironically, many people stop learning precisely when they begin earning. After school or college, books become optional. Reading is replaced by endless scrolling. Hours disappear watching short videos, reacting to headlines, or consuming entertainment that leaves no lasting value. Days become weeks. Weeks become years. Without realizing it, people slowly stop expanding their thinking. Their income may increase, but their judgment remains the same. Buffett understands that stagnant knowledge often leads to stagnant wealth. Because the economy keeps changing. Technology changes. Businesses change. Consumer behavior changes. If your thinking stays frozen while the world evolves, eventually your financial decisions begin relying on outdated assumptions. Learning protects you from that. It allows you to recognize opportunities before they become obvious. It helps you avoid mistakes that others continue repeating. Most importantly, it develops independent thinking. Independent thinking has always been central to Buffett's philosophy. He doesn't invest because something is popular. He invests because his own research convinces him that a business has long-term value. That confidence doesn't come from opinions. It comes from preparation. Preparation creates conviction. Conviction creates patience. And patience allows compounding to work without constant interference. Consider how often people seek financial advice from strangers who know nothing about their goals. A trending video, a viral headline, or a social media influencer suddenly becomes more persuasive than years of careful study. Buffett has never built wealth by following crowds. He built wealth by understanding businesses better than the average investor. That understanding wasn't inherited. It was earned, page after page, year after year, book after book. What's remarkable is that Buffett doesn't view reading as work. He views it as building invisible assets. Every book adds another mental model. Every biography reveals another pattern of success or failure. Every annual report sharpens his ability to separate strong businesses from weak ones. Eventually those small pieces of knowledge connect in ways that most people never notice. That's when judgment becomes extraordinary. Not because of genius, because of consistency. The fascinating part is that learning often produces returns long before it produces money. Better communication improves careers. Better financial literacy prevents costly mistakes. Better psychology reduces emotional decisions. Better business knowledge reveals opportunities that others completely overlook. Those improvements compound quietly, just like investments. Most people simply don't recognize the compounding because it happens inside the mind before it appears inside the bank account. Buffett once remarked that chains of habit are too light to be felt until they become too heavy to be broken. Learning works the same way. Reading one book doesn't transform your life overnight. Neither does studying one annual report or listening to one thoughtful idea. But years later, the person who kept learning thinks differently, decides differently, and ultimately lives differently from the person who stopped growing. And once your mind begins compounding knowledge instead of simply collecting information, you discover one final principle that may be more powerful than all the others. Because even with patience, discipline, emotional control, and continuous learning, there is one habit that determines whether all those advantages actually have enough time to create extraordinary wealth. Imagine planting a seed in your backyard. The next morning, you walk outside expecting to see a massive tree. Instead, nothing appears to have changed. A week passes, then a month. Still no dramatic transformation. Frustrated, you dig the seed out of the ground and plant a new one somewhere else. A few weeks later, you repeat the process again. Year after year, you keep planting new seeds but never allow any of them enough time to grow. It sounds irrational. Yet millions of people approach wealth in exactly this way. They constantly change strategies, switch investments, chase new opportunities, and abandon long-term plans before those plans have a chance to succeed. Warren Buffett has spent his entire career proving that extraordinary wealth rarely belongs to the fastest person in the room. It usually belongs to the most patient. When people hear Buffett's name, they often focus on the billions of dollars he has accumulated. What many overlook is how those billions were actually created. The majority of Buffett's wealth didn't appear during the early years of his career. It came much later, after decades of allowing his investments to compound without unnecessary interruption. This is one of the most misunderstood truths about building wealth. People admire the destination, but they underestimate the time required to reach it. Modern culture encourages exactly the opposite mindset. Everywhere you look, success is presented as something immediate. Overnight millionaires dominate headlines. Social media celebrates instant results. Business stories often skip over decades of struggle and focus only on the final outcome. As a result, many people begin believing that if financial success isn't happening quickly, something must be wrong. Buffett would strongly disagree. He understands that time is not an obstacle to wealth. Time is the very thing that creates it. Think about how compounding actually works. During the early years, progress often feels painfully slow. Investments grow, but the changes appear almost insignificant. Many people become discouraged because they expect dramatic results too soon. They mistake slow progress for failure. Then something remarkable begins to happen. The growth itself starts generating additional growth. Small gains become larger gains. Larger gains begin producing even greater gains. Eventually, the process accelerates in ways that seem almost unbelievable. The irony is that most people quit just before compounding begins revealing its true power. Buffett has often compared this process to rolling a snowball down a long hill. At first, the snowball is tiny. Every rotation adds only a small amount of snow. It doesn't seem impressive, but if the hill is long enough and the snowball keeps moving without interruption, it eventually becomes enormous. The secret isn't finding a magical snowball. The secret is giving it enough distance. Your investments work the same way. Every time you panic and sell too early, you're picking up the snowball before it has reached the bottom of the hill. Every time you constantly switch strategies, you're starting over from the top. Patience doesn't simply increase returns. It allows returns to multiply. This philosophy extends far beyond investing. Buffett understands that businesses require years to develop competitive advantages. Careers require years to build expertise. Relationships require years to establish trust. Reputation requires years to earn. Financial independence itself is usually the result of thousands of disciplined decisions repeated consistently over decades. There are very few shortcuts. Most lasting success follows the same pattern. Slow, steady, consistent. Yet human psychology constantly resists this reality. We naturally crave immediate feedback. We want evidence that our efforts are working. When we don't see quick results, doubt begins creeping into our minds. We start questioning our strategy. We compare ourselves with others. We wonder whether we should abandon the plan and pursue something faster. That impatience becomes incredibly expensive. Because wealth isn't usually destroyed by one catastrophic decision. It's often destroyed by hundreds of small moments of impatience. Buffett rarely appears to be in a hurry. While markets become obsessed with quarterly earnings, daily price movements, and economic predictions, he remains focused on what businesses are likely to become many years from now. This long-term perspective changes everything. Temporary setbacks become less frightening. Short-term volatility becomes less important. Unexpected challenges become part of the journey rather than reasons to quit. One of Buffett's greatest strengths is his willingness to wait while others become distracted. He understands that the market constantly offers opportunities to those who refuse to let time pressure control their decisions. Perhaps that's why he has repeatedly emphasized that investing is simple but not easy. The principles are straightforward. The execution requires emotional discipline. Imagine two investors beginning on the exact same day with the exact same amount of money. One spends the next 30 years reacting to every headline, changing strategies, chasing trends, and trying to predict every market movement. The other quietly continues investing in productive businesses, ignores daily noise, reinvests returns, and allows time to perform its quiet work. At first, the difference between them appears surprisingly small. 5 years later, it becomes noticeable. 10 years later, it becomes significant. 3 decades later, they seem to have lived completely different financial lives. Not because one discovered a secret investment, but because one respected time while the other kept fighting against it. Buffett's philosophy has never been about predicting the future with perfect accuracy. It's about preparing for a future that rewards patience, rational thinking, disciplined behavior, continuous learning, and the willingness to let great decisions mature instead of constantly replacing them. The people who ultimately build lasting wealth aren't necessarily those who move the fastest. They're the ones who understand that the greatest financial rewards often belong to those who are willing to wait long enough for ordinary decisions to become extraordinary results. As we reach the end of this journey, one truth becomes impossible to ignore. Warren Buffett's path to extraordinary wealth was never built on secret formulas, perfect market timing, or unbelievable luck. It was built on ordinary decisions made with extraordinary consistency. Think about the 7 habits we've explored. Chasing quick money, letting emotions control financial decisions, spending tomorrow's wealth on today's lifestyle, ignoring the power of lifelong learning, thinking only in the short term. Each of these habits seems harmless in the moment. None of them feels like a life-changing mistake when it happens. But over years and decades, they quietly shape 2 completely different financial futures. One future is built on reaction, impatience, comparison, and constant distraction. The other is built on ownership, discipline, knowledge, patience, and long-term thinking. The remarkable part is that these choices aren't reserved for billionaires. They don't require a special education, an extraordinary income, or access to exclusive investment opportunities. They begin with something much simpler. A decision to think differently than the crowd. A decision to value ownership over appearance. A decision to stay calm when others panic. A decision to keep learning when others stop growing. A decision to let time become your greatest financial partner instead of your greatest source of frustration. Buffett often reminds us that someone is sitting in the shade today because someone planted a tree a long time ago. Wealth works the same way. The financial freedom you hope to enjoy years from now depends on the habits you choose today. Every dollar you invest, every book you read, every emotional decision you avoid, and every unnecessary purchase you resist becomes another seed planted for your future. You don't need to become Warren Buffett, but you can adopt the principles that made his success possible. Because lasting wealth isn't created by one brilliant investment. It's created by thousands of wise decisions repeated long after the excitement has faded. So the next time you're faced with a financial choice, don't ask yourself, will this make me rich tomorrow? Ask yourself the question Warren Buffett has answered with his entire life. Will this decision still make sense 10 years from now? That single question may become the moment your financial future begins to change. If you found value in today's documentary, let us know in the comments which of these 7 habits you're committed to leaving behind. And if you want more timeless lessons on investing, wealth building, and Warren Buffett's philosophy, make sure to subscribe and join us for the next documentary, where we'll continue exploring the principles that have helped ordinary people build extraordinary financial lives.